Netflix has recently fallen on some very hard times. Its stock price is down roughly 70% from the highs that it set in November 2021, and it's gotten many investors wondering whether or not they should be buying the dip. Because as history has shown, buying the dip has generally been a very good idea for long-term investors putting their money into broad-based market index funds, like the S&P 500. However, does the same hold true for individual stocks? Let's find out by looking back at the history of individual stocks that have taken massive hits to their share prices to see what happened next, so that we can determine if buying the Netflix dip, or the dip of any large individual stock that takes a similar nosedive, as I'm mainly using Netflix as a convenient jumping off point for this topic, is generally a good approach that works out well for investors. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. So before we get into the actual history of the aftermath of individual stocks that have taken a significant nosedive, I want to put into perspective why this is even a debate. As I said a moment ago, buying the dip on a broad-based market index has historically been a smart move for investors because, at least so far, the markets have always recovered to set new all-time highs. Maybe not immediately, but eventually. Therefore, investors who have funneled some of their money into the markets when they're down have typically experienced a noteworthy boost in their net worth over time. Take the Great Recession of 2007 to 2009, for instance. If you had invested $5 a day into a simple S&P 500 index fund between January 2007 and April 2022, you'd have a net worth of approximately $56,600 today, with $19,290 of that coming out of your own pocket. If you had invested $10 a day when the markets were down at least 20% from their all-time highs, and then $5 a day on any other day, you'd have a net worth of approximately $70,900 today, with $21,965 of that coming out of your own pocket. In other words, for an additional investment of $2,675 over a 15-year period, you increase your net worth by over $14,000. And as you can imagine, that gap widens even more over longer time periods and with more downturns, because obviously the 2010s was a pretty calm decade for the markets, relatively speaking. However, when it comes to investing in individual companies, there are a couple of differences that are worth noting. The first is that, depending on the company in question, it's entirely possible that you'll experience much more volatility, for better or worse, than you will with the market as a whole. This is one of the reasons that buying the dip on an individual company can actually be so tempting. The potential payoff if they do bounce back is just so tremendous. Take Netflix, for example. Let's say that, hypothetically, they do eventually recover from their price drop. They've fallen roughly 70% from their all-time highs at the time of this video in late April 2022. If it takes them a year to recover that loss, that suggests that your return on investment for that year would be over 230%. If it takes 2 years to recover, your annualized return is still something like 83% a year. And even if it takes a full 5 years for Netflix to just get back to where they were last November, your annualized return for buying the dip would come out to be around 27% per year. Now that's roughly triple what you'd expect to earn over the long term with a broad-based market index fund strategy. For some people, that potential reward may very well be worth the risk of losing any money that they decide to put in. A second difference that'll be important to keep in mind for later on in this video is that, unlike a broad-based market index fund, individual stocks don't have the ability to balance out their own losses with gains from other stocks, since by definition, there are no other stocks. This could lead to more frequent downturns that would trigger an opportunity to buy the dip, which on the surface is great. Again, the potential rewards for a stock that bounces back after a huge sell-off is, well, huge. But there's still the fact that a recovery is never guaranteed with an individual stock. With that being said, let's take a look back at history to see how companies that take massive hits to their share prices tend to fare going forward. To figure out how individual stocks performed following a major sell-off, I looked back at the annual recaps of the top and bottom performers of the S&P 500 to find the worst performing companies for each year between 2007 and 2016. Why 2007 and 2016? It's because I wanted to get an idea of how these individual stocks performed during both bull and bear markets. Since there really wasn't any major bear markets in the 2010s, I had to go back to before the Great Recession. I also wanted to make sure that I gave the companies adequate time to turn things around after the sell-off. Ending things in 2016 meant that I had 10 years worth of companies to pick from, and it gave those companies a minimum of 6 years to turn things around. I filtered out the companies whose share prices didn't fall at least 25%, since we're trying to compare to something significant like Netflix, and that left me with a little over 50 companies to analyze. Of those companies, about 24% of them eventually either filed for bankruptcy, thus having their share price go to zero, or were acquired by another company. Sometimes this happened shortly after their sell-off, and other times they managed to survive several years before the end came. But in either case, their stocks are no longer available for purchase today. The remaining companies paint a somewhat dismal picture, with a few notable bright spots. Let me explain. The average annualized price return of these companies, if you started investing at the bottom of the sell-off, clocks in at around 12.6% per year as of April 2022, which is excellent. Only about 10% of the companies that weren't acquired and didn't go bankrupt actually have a lower stock price today than they did at the bottom of the sell-off. Even if we assume that every one of the companies that eventually got acquired continued to struggle in between the sell-off and the acquisition, that still suggests that you've got a roughly 2 in 3 shot of making money by buying the dip on these companies. Not bad. Unfortunately, that statement does come with a pretty big caveat, which I'm sure many of you have already caught. It presupposes that you buy in at the bottom of the sell-off. In other words, it assumes you successfully time the market with a pretty extraordinary amount of precision. In reality, it's almost impossible to pick out when a stock has bottomed out in real time. Netflix is down about 70% at the time of this video, but I have no idea whether or not that'll actually end up being the bottom. By the time you're watching this, it may actually be down even more, or it may be well on its way to recovery. We just don't know. So how do these figures look if we say that you bought the dip at the start of the year following whichever year the sell-off occurred in? So if the sell-off began in the summer of 2007, you'd buy the dip in January 2008. That way you're not buying at the bottom, per se, but you are still likely buying when the stock is very much on sale. As it turns out, the chances of realizing gains are fairly similar using these assumptions, but the magnitude of the gains take a bit of a hit, dropping from nearly 13% per year to about 9% per year. The crux of this decision, though, is not whether buying the dip is a worthwhile move to make, it's whether buying the dip on an individual stock can generally be expected to outperform the alternative options that are out there. The simplest alternative option you have when we're looking exclusively at individual large-cap US stocks, which we are in this case, is a simple large-cap index fund, like the S&P 500. So does buying the dip on these individual large-cap companies generally outperform simply investing in an S&P 500 index fund over the same time period? Well, not really. Only about 36% of the companies that weren't eventually bought out or bankrupt managed to outperform a simple S&P 500 index fund over the same time period, assuming, of course, that you began investing at the start of the year following the year where the sell-off occurred. The average underperformance of the price returns for the individual stocks was about 2.7% per year, which, while not backbreaking, could be quite substantial over longer periods of time. Now, that being said, if you manage to hit on a real winner, such as AMD after their sell-off in 2012, you could end up significantly outperforming a simple index fund. In January 2013, so the start of the year after the year where the sell-off occurred, AMD was trading at around $2.50 a share. Today, it's trading at over $85 a share. That's an average annualized return of about 46% per year, which, even considering that this took place during basically nothing but a bull market, is still insanely good. Of course, extremes exist in the other direction too, such as Hovnanian Enterprises, which fell from over $925 a share in 2007 to around $46 a share today. That translates to average annualized losses of about 18% per year, which over such a long time period is incredibly bad. And that's a company that still exists today, which is more than we can say for some of the other companies in this group. So in summary, it would seem that history suggests that while it is entirely possible that an individual stock coming off of a major sell-off can outperform an alternative investment approach, like a simple S&P 500 index fund approach, and potentially by a substantial amount, it's far from a guarantee. And assuming you aren't fortunate enough to time the market reasonably well, the odds of outperforming, at least on a price return basis, falls to roughly that of a coin flip, and maybe even a little less. Now, whether that risk-reward trade-off is worth it to you is something that only really you can decide for yourself, but that seems to be the rough outline of the story that the historical data is telling us. Personally, I have no plans to invest directly into Netflix, or any other individual stock that suffers a similar sell-off. I'd rather stay more diversified and raise my return floor closer to what I'd need to reach my long-term financial goals. But that's just me. You may feel differently, especially if you're only investing a small portion of your money into these more risky but potentially potentially highly rewarding stocks. But these findings raise the question, why does buying the dip nearly always work out well when it comes to investing in a broad-based market index fund if the same approach is less certain to lead to success with individual stocks? Especially when those individual stocks are of a similar makeup to the index fund you're comparing it to, which in this case they were. The answer reveals one of the more underrated benefits of index fund investing. Index funds are self-cleansing by design. Let me explain. Stock market indexes often have certain criteria that individual stocks need to meet before being listed on that index. One of the most common examples is that a company will have to meet a certain market cap threshold, in other words, to be big enough to make it into the index. For our purposes, what this means is that the makeup of an index fund is dynamic. From time to time, certain companies will fall out of the S&P 500 and be replaced with new companies, and this is reflected in the index funds. If the reason for the company being removed from the S&P 500 was because its value had fallen enough to no longer qualify based on its market cap, then an index fund investor will not experience any further declines in the value of their investment if that company continues to struggle after its removal. In other words, barring some truly market-wide collapse in value, the losses an index fund investor can experience is capped to a certain extent, because struggling companies will eventually be removed from the index and replaced with companies that are performing better, relatively speaking. Whereas an investor putting their money into individual stocks could see their investments completely wiped out if their holdings struggle and remain static over time. Now, that isn't to say there isn't potential drawbacks to this self-cleansing nature, because while it does provide a valuable perk by more or less guaranteeing that you'll never be completely wiped out, if you remove a company from the index due to their recent struggles and then it bounces back, index fund investors may not see the full benefit of that recovery, since it'll take time for the stock to rejoin the index. Funnily enough, this actually happened with AMD in September 2013. At that time, AMD's share price sat at $3.81. It would fall an additional 50% to just $1.72 by September 2015, but because it was removed from the S&P 500 in September 2013, index investors avoided this portion of the drop. However, AMD recovered way better than most individual stocks do after having taken that large of a hit to their share price. By March 2017, when it rejoined the S&P 500, its share price stood at $14.55. Index fund investors missed out on those gains. So while there is a give and take, this self-cleansing cycle tends to help market indexes trend up and to the right more often than not over long periods of time, because it drops the laggards and picks up the overachievers. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.